Where you receive good information for your mortgage needs, such as mortgage programs and foreclosure programs to help get you out of foreclosure. Stay tuned and hear what's coming your way.
And welcome to Mortgage Talk. Glad to be here with you on Mortgage Talk. Man, feels good to be here on speaker.com, and we're here with you, Blog Talk Radio. Glad to be here with you guys, iHeartRadio just as well. Glad that you are tuning in to us here on Mortgage Talk. Man, glad to be back intact with the team. I want to go over some things with you today, and I want to talk to you about some programs that I think will work and work well. These particular programs that I want to talk to you about is about the forbearance agreement program. Yeah. It's the forbearance agreement program that I want to talk to you about. There were some questions that came on my email, and I got an opportunity to answer those questions, and I'm glad that I did, because it gave me the opportunity to be able to share those questions with you. So it gives me a chance that I can share that with you. And so I'm gonna read the questions to you, and I'm going to give you the answer that I got. But at the same time, I want to tell you how you will be able to send me questions if you want to do that. It's real simple, real easy. All you have to do is just go to Mortgage Talk Facebook page. Yeah, that's right. Mortgage Talk Facebook page. You can go there and you can inbox me the question, or you can go to WHPNN Radio Network, and because they have a Facebook page, WHPNN Radio Network, and you can inbox Mortgage Talk and ask the questions there. Or you can email me, real simple, at mortgagetalk1, the number one symbol, at gmail.com. That's mortgagetalk1, the number one symbol, at gmail.com. And you can send me your questions and I will answer them. And if it's okay with you, I will share the questions with our audience when we air. Okay? So I will definitely answer the questions. Don't be alarmed if you send it to me today and I don't answer it until a day later. Please give me 24 hours to to answer your questions. Give me 24 to 48 hours to answer your mortgage questions, and I would do so. Okay? Just want to share that with you. Now, I want to just excuse me. I want to just go over the question that was asked of me, and one of the questions was, what is a MIP? What is a MI and a PMI? Can you explain what that is? Okay, sure I can. These are mortgage terminologies that hold meaning and that you will find in your contract. So when you see these terminologies, they're mostly going to be associated with your promissory note. They're going to be in your promissory note. So when you hear the term of MI stands for mortgage insurance. And when you see the term of PMI is private mortgage insurance. When you see that term MIP, basically the same as PMI, that's mortgage insurance premium. Okay? Now, to offset the default risk to the lender, when the borrower has purchased a home with a low down payment, meaning that when the borrower had purchased a home and he purchased a home less than 20%, whether it's a conventional loan or a FHA loan, because with FHA, you put 3% plus closing costs. Great deal. Wonderful. Superb. But you put down less than 20%. And sometimes people have, because under FHA, some people go with FHA because they have some credit challenges. Now, they have to make sure that they don't have any current collections to qualify. And if they do have some, they need to pay it out and have proof that they have paid it in order to qualify for FHA. That makes that individual a high risk. But FHA stepped in under the government, to help people, even though they have challengeable credit, to be able to get the American dream. So when that happens, they come up with a policy. Everything has policy. Everything is insured. They come up with a policy, an insurance policy that will give protection to the investor and bank. In other words, MIP, which is mortgage insurance premium, is an insurance policy used by FHA loans. They're on all FHA loans. Okay? MIP, mortgage insurance premium, is a loan, is an insurance policy that's accompanying your loan that you pay for, by the way. You pay for that. Okay? You pay a 0.05% of that. You pay for that. It used to be about a couple of years ago that as you paying down the principal and interest, and you pay down more than 20%, the MIP drops. But not anymore. Not anymore. Under FHA now, the MIP is going to stay with the loan for the duration of the loan under FHA. So it's an insurance policy because you are higher risk. FHA insured the loan, But FHA needs some insurance themselves because they insured the loan through the lender that loaned the money that you never saw. And FHA insured it that if you default, they will pay them. But if you default and FHA pays them plus their mountain of fees that they don't challenge them on, the lenders, then FHA needs something back. And so this insurance policy helps pay back the money back to FHA. Okay? Because you failed to put down 20%. If you put down 20%, then you will not have MIP. Now, you can refinance this over a period of time. And when you refinance, let's say that you have the loan for maybe about 10 years, okay, or 5 years, whichever which, and you refinance. As long as from the original loan amount, that when you refinance, you've already paid down the 20% originally. And if you didn't, then you need to include the down payment of that, eating up that 20%, so the MIP don't apply to your next FHA loan, because you may do a FHA refi. Guarantee you that lower rate. That's a good thing about being on the FHA. Or if you do a FHA streamline, which is only for rate and terms. Be careful, because if you do an FHA streamline, you better make sure that you have paid that 20% down over those years. Okay? Because there is no cash out under that. However, you can apply a down payment to pay down that principal and interest even under a streamline. All right? So you'll be protected under that streamline either way. If you do FHA refi, normally people want to take money out when they do a FHA refi. That's why I said be careful, because if you're looking to take money out, then FHA streamline is not what you're looking for. But if you're looking for rate and term reduction, especially with interest rate being at the all-time low, then that becomes a tangible benefit factor for you. And so therefore, you will be able to do that. Okay? Just want to share that with you. Now, PMI, which is private mortgage insurance, that helps the lender just like MIP helped the investor, FHA. PMI helps the lender. It extends the mortgage to a customer who may not otherwise qualify for a loan. So again, a client that puts down less than 20% going under a conventional loan, PMI can be applied. Even non-conforming, PMI can be applied because you put down less than 20%. Okay? And because you did that, the lender needs something just in case you default. In other words, you ain't putting enough sugar in the game. You ain't got enough skin in the game. So because you put less skin in the game, the lender put practically almost all of the skin in the game. They want some insurance in case something were to happen. All right? PMI provided by private companies, private insurance companies, is technically available in a variety of premium plans and offer payment options that can usually be tailored to the borrower's need. There are numbers of private mortgage insurance providers, each structure their offering a bit differently. Another difference from PMI to MIP, there is no upfront mortgage premium required. When you on MIP, on the FHA, you have to pay a upfront premium requirement, and that would be added to your closing costs under FHA. But there is none upfront under PMI, private mortgage insurance. PMI can be canceled after the LTV, loan to value, another mortgage term, has dropped, that you have paid down 20%. You can contact the PMI company and cancel it out. And I hope that you caught the fact that there are PMI companies that you can go and apply yourself to a PMI company. Most people that get PMI don't even know what the name of the company is. Whether it's FHA, VA, or conventional or non-conforming. None of them knows who the name of the company or even what their loan number is. Because because it is an insurance policy, so you have a policy number. Okay? You need to make sure that that information is given. Even your attorneys at the table, not all of them, don't even tell you. Because they concentrate on the structure of the loan and your understanding of the promissory note and the mortgage deed, and your understanding of any default factors of what could happen. They focus pretty much on that. But you need to focus, when you're paying less than 20% down, on who is the PMI company. Okay? Because there's a couple of big major ones, but who is the PMI company? And what is your policy number? And what is the phone number? You need that information. Because when you have that information, as an educated consumer, the best customer, which was Mortgage Talk is all about, helping you, making sure that you are the educated consumer, the best customer in the mortgage industry, and at least have some understanding of the insurance industry. So you don't fall victimized or you don't shortchange yourself in the insurance industry just as well. Okay? So that's the difference between PMI and MIP, and MI, which is mortgage insurance. That's the difference between them. Okay? You can cancel PMI. You can even get your own PMI from a PMI company. Okay? You don't have to just take what they give you. All right? But usually buyers don't know this. A lot of buyers, and even older buyers, they don't know this. So you go to close and they already got one for you. And you don't want to prolong the closing just so you can shop a PMI company and maybe save $2, $3, $4, $5, $10. So you just may say, what the hell with it? I'll just take that, or you look at it as it's something that the lender does. And it is, but you can reject the company as an educated consumer and can say, I don't want that company. But see, those are questions that you're going to ask up front when you get approved. Whether it's through a bank or whether it's through your mortgage broker. Mr. Broker, who is the PMI company? Well, I don't know. Can you find out for me? I don't like that PMI company. I'm going to get my own. Well, I don't know if the lender's going to let you. Sure, the lender is going to let me do that. I'm an educated consumer, the best customer. Of course they're going to let me do that because it's my decision under PMI, private mortgage insurance. Under MIP, under HUD, you cannot do that. Okay? You cannot do that. The investor will choose the PMI company under HUD. Okay? Got to move on. So that's what your PMI, MIP is, and MI is mortgage insurance, and that's what that is. Okay? The next question that I got was, what is a 5/1 mortgage loan? What is a 5/1 mortgage loan? And when you answer that, Rick, can you also answer what is a 3/1 mortgage loan too? Okay. I'm saying that so you can keep up with me on the radio because you can't see what I'm looking at. So I'm basically helping you to visualize what I'm talking about. What is a 5/1 mortgage loan, aka better known in today's time as a hybrid loan? That is known as a hybrid loan. In my time, and maybe still a little bit, it is known as a adjustable rate loan. It is known as a adjustable rate loan. Now, a 5/1 mortgage loan, or better known as a blend loan, because it has three names, a blend loan or known as a hybrid loan. A blend, why it's called a blend? Because it's a blend of a fixed rate loan and in combination with a adjustable rate loan. Also referred to, as I said it earlier, a adjustable rate mortgage loan. You may see the acronyms of ARM in a parentheses. It means adjustable rate mortgage. Okay? Let me say it another way. Okay. Combine a variable rate mortgage and a fixed rate mortgage. That's what that 5/1 mortgage loan is. The 5 itself indicates that the loan interest rate will remain fixed for 5 years. That's what that means. It will remain fixed for 5 years. The rate will adjust one time per year at the end of the 5th year until the loan has been paid off. Okay? How much will the rate adjust depends on the rate index to which the loan is tied to. It can go up or it can go down. And with rates falling, people that are on adjustable rates are doing very, very good. Some of them was on a 5% adjustable rate, and now they're at 2.39. Those are some of the advantage that adjustable rates can do for you. But some of the disadvantages, when interest rates go up, then that rate will go up. And it will go up one time each year after the 5th year. So you got a 5-year lock on the fix before that rate turns in after the 5th year. In the 6th year, the rate will go up by 1%. Now, what you got to find out is 1% mathematically is not the 1% that we are accustomed to in our minds. That 1% mathematically, depending on the investor, depending on the bank, the 1% could be 0.500, could be conceived as 1%. Under the non-conforming end, 0.325 can be considered 1%. Okay? It's not a 1% as a 1%. They take it in that mathematical form of 0.500, considered 1 point. Okay? That's considered 1 point. So remember to ask the questions. Now, there are other hybrid loans like a 3/1, a 7/1, and a 10/1. And now you know what it means. It just means that the rate will be fixed for 3 years. And in the 4th year, it will go up or down, depending upon the market. Same thing with the 7-1. The rate will be fixed for 7 years. Same thing with the 10/1. The rate will be fixed for 10 years. And in the 11th year, it will either go up or go down, depending upon the market. Okay. There's another rate called a 6-month LIBOR, where the rate is good for 6 months, and then it will go up in the 7th month. The 6-month LIBOR interest rate, USD LIBOR interest rate, is the average interest rate at which a selection of banks in London are prepared to lend to one another in American dollars with a maturity of 6 months. It reports the 6 months LIBOR on or after the first of the month. This is the LIBOR for 6 months deposit in US dollars on the last business day of the previous month. For instance, the report rate for February is the rate published on February the 1st, reflecting the LIBOR for January the 31st. Okay. Moving on. I want to talk to you about the forbearance agreement. But I want you to know that there is a modification loan agreement too. Most people will go on a forbearance agreement, and when that forbearance agreement is up and their situation is still the same, then they will go and qualify for a modification. And a modification is a 1-year term. So now they have another year that they will be able to remain in a home while they fix their financial situation. A loan modification is a change made to the term of an extended loan because the borrower is unable to meet the payment under the original contract promissory note term. The loan modification now has been requested, and the loan modification will modify the promissory note. Okay? The forbearance agreement is more or less looked at as a short-term relief or solution. The loan modification is looked at as a permanent solution. Once the contract has been modified, the old contract ceases to exist, the new modification of the contract exists, and you ride it out for the duration of that particular time. A forbearance agreement gives you a shorter term in working out the difference. Now I'm going to tell you what that is, but I'm going to take a inspirational song break, and I'm going to come right back, and I'm going to finish up and close out the show by telling you about the forbearance agreement. And there are two types of forbearance agreements out here today. There is the U.S. government forbearance agreement issued by the Trump administration, and there's a forbearance agreement issued by your bank, the servicer. I'm going to tell you the slight difference between those two when I explain to you what a forbearance agreement is, if some of you don't know. But you do know that these are the two programs, modification and forbearance agreement, that you can decide which one's going to work for you. Remember, the modification is modifying the loan. That means that they look at the rears, look at the total that you owe, and they would drop the interest rate, especially with rates being low now. You may be at a 6.1. Well, now that rate may be dropped down to a 3.2 or a 2.9. That automatically is going to reduce your payment. The arrears sometimes can be forgiven under the modification. And not only can the arrears be forgiven, but more of the principal and interest can also be forgiven depending upon how long you have had the loan. That plays a role. You had the loan for a short period of time, not much is going to be forgiven. Okay? But if you have the loan for a while, because you know when you pay out the biggest ticket you have ever had, which is a home, you know you're paying 3 times the amount of the loan amount that you bought. That you asked for the loan for. So therefore, there's some open room there that they can do some forgiveness. So any amount that they forgive to you under the modification, you need to know that and talk to your accounting that modification amount that they forgave will be considered a income to you. So you have to pay taxes on that. I'm not a tax accounting, so you need to talk to your tax accounting. They'll explain to you how that will go. It's a good relief for you when they forgive you of a large amount, $30,000, $50,000 or more, but you will have to pay taxes on that. So if you're looking forward to getting money back, you need to really talk to your tax accountant so they can work out some things for you to really kind of help you out, okay? Just want to let you know that. The other modification that is the other modification is offered by the federal government, and they took it from the Obama administration back in 2008 when they modified it in 2009, called the HAMP program. Under HUD took the HAMP program and called it FHA HAMP program, which is Home Affordable Modification Program. So you have the modification issued to you by the lender, and if you're on a FHA loan, you would get the FHA HAMP program. If you're on a VA loan, VA has their own modification program, and you would get on the VA modification program. If you're on Sallie Mae have their own modification. Freddie Mac and Fannie Mae have their own modification program. They're not part of the federal government. They are a LLC company that has a contract with the federal government, and I'm speaking in terms of Freddie Mac and Fannie Mae. So if you have a Freddie Mac loan or a Fannie Mae loan, they have their own modification, okay? And they have their own forbearance agreement, okay? So you need to know that. So you need to know what type of loan that you have so you can know where to go to get help if you're in foreclosure right now, okay? So those are your 2 types of modification for non-conforming and conforming. Your servicer or investor will offer you a modification, but you will have to qualify through debt ratio, and you will have to be able to make the payments when they modify the loan, which you're usually going to pay a far less than what you're paying right now. Okay. Now, if you want to hire a lawyer to go do it for you, then that's on you. You can. Banks don't like dealing with lawyers, and because all I's and T's has to be dotted and crossed. And when that happens, it takes longer for that modification to be final when you're involving a lawyer. When you involve a mortgage broker, even though we were down as almost being extinct, but a lot of us is coming back. Mortgage brokers get it done within 60 to 120 days. So if you know a mortgage broker, you may want to go to that mortgage broker if you trust that mortgage broker. Okay? There's nothing wrong with you going to an attorney. Make sure that it's a real estate attorney or a bona fide attorney that does modifications and have a reputation of doing modifications. Then you may want to go to that attorney. Okay. Of course, you're going to pay them fees, and they're not cheap. All right. So just to let you know. So all I's and T's has to be dotted and crossed when you're dealing with those attorneys and dealing with any mortgage broker. Now, I'm going to come back and I'm going to talk to you about the forbearance agreement. We're going to take a inspirational song break, and then we'll come right back, and I'll be with you again right here on Mortgage Talk. So back in a moment with more of Mortgage Talk.
Everything's all right. Is everything all right? Everything's all right. Been saying. Everything is all right. Everything's all right. Is it all right? Everything's all right. Is everything all right? Everything's all right. Been saying. Everything is all right. Working out fine, got everything I need. I've been putting in work, so I'm stacking up G's. And I'm pleased as I cruise down the road. Sunshine beaming in, and I sport a little go. I ride through the hood and everybody is down. I get a lot of love because I spread the love around. And ain't nothing changed but the cash and the flow. And if you try to front, you better act like you know. Miss me with the drama, cause the good times is here. And I done lost a lot of homies, so I'm glad to be here. I feel like dipping and bouncing in the sun. I'm rolling with my homies, cause two is better than one. We bouncing to the park, then we heading to the beach. We been working real hard, so it's time to release. And get a little taste of the real good life. Dismissing all the stress, cause everything's alright. Is it alright? Everything's alright. Is it alright? Everything's alright. Is everything alright? Everything's alright. Been saying. Everything is alright. Is it alright? Everything's alright. Is it alright? Everything's alright. Is everything alright? Everything's alright. Been saying. Everything is alright. They said you couldn't pay and you got it paid. They said you couldn't make it, but you got it made. They said you couldn't buy yo, but it got bought. And they said you couldn't learn, but you ain't never been taught. You see, life is like that on this side of the world, but you gotta keep going to make it well. Don't never let them tell you that you can't get it done. You can start off at the bottom, then creeping number one. And now you're bouncing with the homies on the way to the club, and everybody wanna party and show a little love. Keep my heads on right, cause we living the life. We don't start no drama, but don't play us too tight. We got much love, cause we from the same place, and we wanna see you up, cause we in the same race. And we can't quit if me and you fight, so we gonna work it out and make everything alright. Is it alright? Everything's alright. Is it alright? Everything's alright. Is everything alright? Everything's alright. Been saying. Everything is alright. Is it alright? Everything's alright. Is it alright? Everything's alright. Is everything alright? Everything's alright. Been saying. Everything is alright. Is it alright? Everything's alright. Is it alright? Everything's alright. Is everything alright? Everything's alright. Been saying. Everything is alright. Is it alright? Everything's alright. Is everything alright? Everything's alright. Been saying. Everything is alright. When you think that there's no way out, you gotta pick yourself up and kill that doubt and take a little ride and ease your mind. Cause everything is bad gets better with time. Cause I don't like to see you with all that pain. And if you ever need to talk, you can talk to me, man. And I'll share my love, cause you know we tight. And we'll bring it on out and make everything alright. Is it alright? Everything's alright. Is it alright? Everything's alright. Is everything alright? Everything's alright. Been saying. Everything is alright. Is it alright? Everything's alright. Is it alright? Is everything alright? Everything's alright. Been saying. Everything is alright. Is it alright? Everything's alright.
Okay, and welcome back to Mortgage Talk. I'm Rick Montgomery. Glad to be here with you guys on Mortgage Talk on Speaker.com and also on Blog Talk Radio and on iHeart Radio, and we on pretty much of all of the other major directories. And we thank you for you tuning in and being here with us here on a Friday for Mortgage Talk. It's our special edition since we did this show earlier a couple weeks ago, but we got emails back from iHeartRadio, Spotify. We got an email back from I didn't even know that we had them, which was Amazon Music, and they said that the recording was terrible. They said it came out terrible, and so I responded back to them that we will redo the show. I had no idea that it came out that way. So we made some adjustments, and so other than that, Mortgage Talk is on every Tuesday, except for the last Tuesday of the month, in which we're on Wednesday. But we're on every Tuesday at 6:30 is when we come on, and so and we're glad to be back intact with the Mortgage Talk team because we've been off for quite a long time. So glad to be back intact with the Mortgage Talk team up under the umbrella of WHPNN Radio Network, and glad to be part of WHPNN Radio Network that started and began along with Mortgage Talk at Blog Talk Radio. So we're glad to be back intact there, and also glad to be part of the Speaker.com family. So we're glad to be there too. So with that said, I want to talk about the forbearance agreement. Dave the man, of course, he's our engineer. He's in the house with us. So we thank Dave so much for being here. I want to talk about the forbearance agreement. And I'm going to come back and I'm going to close it out because it's all going to come together when I talk to you about the MI. Because let me tell you about the mortgage insurance. So I'm going to bring that together. I know I tell you about the PMI and I know I tell you about the MIP. But I'm going to close it with the MI after I conclude the forbearance agreement. Okay? The forbearance agreement, the mortgage forbearance agreement, is looked upon as a short-term relief. Okay? This plan agreement made between the mortgagee and the mortgager. The lender is the mortgagee, and you, homeowner, is the mortgager. It is because of delinquent payments that cause this forbearance agreement to come about. It does not modify the loan. It is just an agreement to help struggling homeowners to make mortgage payment notes, okay? To make your promissory note payment. In this agreement, the lender agrees not to exercise its legal rights to foreclose on you, the borrower, the mortgager. And the borrower agrees to the mortgagee to make the mortgage, to agree to the mortgage plan that will, over time period, bring the borrower current on their payment. Now, this forbearance is what a forbearance agreement is. And the forbearance agreement generally reduces or entirely reduce your suspended arrears and the mortgage note payment. It takes them, combine them back along with penalties and fees, and they will reduce them. Okay? It used to be, and I can tell you this, they used to take it and either do several things, either take it and put it in the back end of the loan and jumpstart you all over again. Which basically means what they did was if you're at 23 payments to go and they put that in the back, now you're probably at 31 more. Now you're at 31 payments to go. Okay, that's usually how that works. Okay, or they will just forgive it and say you don't owe it. And we'll jumpstart you. But in this program, or what they do is that they take it and they reduce the interest rate to help you out and reduce some of the rearage and add it back into the loan where it does not increase your time of paying the loan. If you had 22 payments to go, you'll stay at 22 payments to go. Okay? This is for borrowers with a temporary financial problem not considered as a long-term solution. So they'll give it to you in 6 months intervals. Okay, you may say, hey, look here, they reduced my paycheck at work. I got sent to another department. I'm applying around, looking around so I can get myself back up. I can't afford to make the payments that I'm making right now. Okay, Mr. Collins, how much can you afford to make? I can afford to make X, Y, Z. Oh, okay. Well, then they'll work with you and modify. Well, not modify, but will set that payment forbearance agreement plan where you can afford to make it. Okay. So now when you get another job and you improve and you did it in that 6 months time, you can be taken off the forbearance agreement. But if you need more time, then they would extend that for another 6 months. So a forbearance agreement, even though it's in 6 months intervals, it can go for 1 year. And at the end of that 1 year, if you still in the same predicament, you still have not found anything, especially in the time right now, especially during Corona-19, then there is no more forbearance agreement for you. You would then be moved to another program, and that program would be a modification program. Okay? That'll be a modification program. Right? So you still have hope without you playing your last card, which is bankruptcy, to save your home. So you still have hope when you're on a forbearance agreement. Okay? The borrower must resume the full payment at the end of the period. Now, in the forbearance agreement, they will even suspend you making a payment. So if they suspend you making a payment because your money was down or your better half passed away, they will suspend the payment for 6 months for you. They will suspend the payment for an additional 6 months for you. Okay? It all depends on your circumstances. Everybody's circumstances is different. So therefore, it is applied toward each individual's circumstances. All right? So the borrower must resume full payment at the end of the period if your payment was suspended, plus any additional amount to get current on the missing payment, including principal, interest, taxes, and insurance. What they normally would do is that when you get off the forbearance and you don't need to go to a modification, you are back intact again, then you either can make that one lump sum payment, which is basically paying up your paying up your homeowner's insurance, okay? Because when they suspend the payments, no homeowner's insurance payments went out. But what you should do when you're on the forbearance, you should make your homeowner's insurance directly to your insurance carrier. You automatically know from your statement how much your homeowner's insurance is per month that they take it from you and put it in your escrow. What you need to do is make that payment. Okay, so you go and make that payment even though you are being suspended for 6 months or a year under the forbearance. Keep that payment going. So now all you have to do is just jumpstart your payment fresh again, and you don't have to worry about coming out of your pocket with additional funds. Because if you can't do that, then what happens is that they'll take what you owe in a homeowner's wise, plus you have a negative escrow, by the way, but they take what you have in a homeowner's wise and then break it down into a 12 months payment, which will increase your mortgage payment, okay? Even if they gave you a great deal in the reduction of your mortgage payment by reducing the rate and maybe forgiving the arrears that you owe, but because you had that 1 year layoff without making a mortgage payment, or a 6 months layoff without making a mortgage payment, you still have to catch up on your homeowner's insurance. All right? Now, COVID-19 has hurt so many people. It has hurt so many people until under the Trump administration, they come up with the government forbearance agreement. And what the government forbearance agreement is basically the same as the forbearance agreement with the servicer, except for the governor's forbearance agreement automatically gives you a 1 year. You don't go into 6 months interval where they reevaluate you, and then if you need to go for 6 more months, they do it. Not up under the government forbearance agreement. It is a 1 year where your payments is suspended for 1 whole year. So if you're in foreclosure right now, remember that's the difference between the servicer or your investor forbearance, because you can get it like the federal, or let's go back to what I said before. You'll be making payments in a forbearance agreement because everybody's situation is different. So some people will be making payments, some people will not be making payments under the bank forbearance agreement, okay? You'll get reductions. You will get, maybe sometimes you may even get the arrears forgiven or some of it forgiven, all right? The interest rate may be reduced under the forbearance agreement sometimes. Not all the time. Not all the time. Everybody's case is different. So the difference with the government forbearance agreement is that your payments is automatically suspended for 1 whole year. There is no derogatory reporting to your credit for 12 months. Nothing is reported there. So you don't lose your credit rating, or your credit rating don't go down. Under the governor forbearance agreement for that 1 year time, you don't go into foreclosure. That is suspended. That's taken out. So you don't have that. So you don't have to worry about that. If it was filed in court, whereas when a lawyer files, they like to put it on title. The government will have that suspended, meaning that the lawyer now has to go and recall that back. For that whole 12 months, nothing on public record cannot be shown that you are in foreclosure, okay? Under the government forbearance agreement. At the end of the 12 months, then you will be evaluated, and if you can make your payments, your normal regular payments, make it. But understand this. You still will have to pay your homeowner's insurance, either in that lump, or they'll work with you and working out a payment plan for you, but you will have a negative escrow, and your mortgage payments will go up to help make up that escrow. And God in heaven knows property taxes is going up all over 50 states. So you're going to have an increase based on property tax just as well. So if you are in the government forbearance or in any forbearance, make your homeowner's insurance payment. Don't wait till the end of the forbearance to do so. Make your homeowner's insurance payment. But you know what you got right here, that if something ever were to happen, you are protected. Now, I want to talk to you about securing yourself. And if you're not in foreclosure, this is something that you need to really get done, because it will protect you from going into foreclosure. We talked about the MI, which is the mortgage insurance. It is really the MIP also, but they don't want to get it mixed up with the MIP that you're paying for under FHA, because it's a whole new 2 different programs. So they'll call it the MI, which is mortgage insurance, which is really mortgage insurance protection. Now that means that you will become the recipient of the mortgage insurance protection under this MIP than you would be under the MIP under FHA, which they are the recipient that you're paying for. Remember, that's an insurance policy. You're paying for it, and FHA gets the benefit. You get nothing if you default. Under your MI or under your MIP, you become the benefit. Your family is the benefit. That means that you become the recipient. If something happens to you, your wife becomes the recipient. If something happens to her, her husband becomes the recipient. If something happens to both of you all, your children become the recipient. The family is protected under the MI or under the MIP where you are the recipient, because that is mortgage protection. That means that if something were to happen, this insurance will pay off your mortgage. What's good about this mortgage protection, it is not under a decreasing term. Whereas as you pay down the principal and the interest, you also are losing the value with the mortgage protection because it's following the promissory note. The federal government felt that was not fair, that here's a person for 30 years who paid their mortgage protection insurance, and now they find out at the end of the 30 years, they got nothing to show for it because the mortgage protection is over. It's over. So therefore, the government said, no. We got to do something better than this. And so they got rid of the decreasing term policy. Now, I understand that a few states still allow the decreasing term policy. But many times, many other states do not. So mortgage protection can come under a whole life policy, and it can come under a term policy. What that does is that it protects you in case something happens to either one of you. Then there's enough funds to not only cover your demise, but it's enough funds to cover the cost of paying out the promissory note. Okay? It can be additional funds if you choose for it to do whatever you want it to do. You can do that. But it is a protection for you and your family, and very inexpensive. It gives you a peace of mind and your family a peace of mind. And hey, what if I live, Rick? What if I live through the whole thing? Well, then the mortgage protection is still there. And if you live through the whole thing, that's great. You pay it out your house. That's great. You still have that dollar amount that you put on there that will pay out the loan. You still have that. You still have that. That is still there for you. And if you operate it under a whole life policy, you not only still have that, but you also have a cash reserve built up. You just made that a bank for yourself. And even under a whole life policy, under the mortgage protection, it protects you against critical, chronic, and terminal illness. So if you catch any one of these things, terminal means that you've been diagnosed. You may live for another year, or you may live for 6 months. You can get up to 75% of your face value. Some companies will pay 50%, depending upon who the insurance carrier is. So in other words, if you have a $200,000 mortgage protection insurance and something happens terminal, you'll get 75% of that. If you have a critical, which means that you had a stroke or you caught cancer, then you can get 50% of your face value under that mortgage protection for you. So, critical, chronic, terminal. Chronic, you can get 25%. Critical, chronic, terminal. You have that protection under your mortgage protection that is within and written within a whole life policy. Now, there are some term policies that comes with riders of critical, chronic, and terminal, but it will cost you extra. Under some companies that carry term, you will also find that there is they will have a cash value that's listed as a rider. But it all depends on who the company is and what the company that's offering that, and the agent who you deal with can offer you that. But you should always have a mortgage protection insurance, because now you're in foreclosure. Guess what? If you had a mortgage protection insurance, you can borrow from that policy to reinstate your foreclosure loan, giving you that protection. You can borrow from your policy. Now again, the policy must be written within a whole life in order for that to transpire from you, but you can borrow from your policy to protect yourself, okay? That gives you that protection and pulls you out of foreclosure. Or you can borrow from the policy even though you're in a foreclosure workout program, just to help you catch up on some bills. You will be able to do that too. So now you can see why that mortgage protection can protect you, the homeowner, now. It can protect you as a homeowner in case something were to happen to you now. You can see that if you catch cancer or a stroke, you can get paid from that mortgage protection policy. You can see now that if something were to transpire with a terminal illness, you can get paid up front to help you with your hospital bills under your mortgage protection. You should keep mortgage protection. It's very inexpensive. Give a call to MCC Financial Service at 708-572-7855. Let me repeat that. MCC Financial Service. They will go over mortgage protection with you, answer any and all of your questions, and guarantee you that you will have a well affordable mortgage protection policy that you can feel safe, your family can feel safe, and you have nothing else to worry about. So call MCC Financial Service at 708-572-7855. That's 708-572-7855. Get your free analysis. Get it now. Know something about it, because you need the protection and you need it now. Too often we go to work and find a pink slip on our desk in today's time due to COVID-19. Too often we don't even know if we're going to have a job next year or not. But so far we're doing good and the money is flowing good. But you don't have mortgage protection. Get your MI. Get that mortgage protection. You see that the lender protects themselves. Did you notice that with the MIP? You see that the lender protects themselves on a conventional and non-conforming loan with that PMI from that private mortgage insurance. You see that they protect themselves. How come you're not protecting yourself? Protect yourself with that MI, with that mortgage insurance. Get that protection. Contact MCC Financial Service. Let them go over with you and give you your free analysis. Let them show you how that mortgage protection can protect you and your family by answering any and all of your concerned questions. Call them at 708-572-7855. That's 708-572-7855. That's it for us on Mortgage Talk. We'll be back Tuesday coming up with you on Mortgage Talk with Blog Talk Radio and Speaker.com. And you can also get us on iHeartRadio just as well. Thank you so much for listening to Mortgage Talk. And if it's the good Lord's will, we'll see you Tuesday. God bless you and may He forever keep you. And thank you for listening to Mortgage Talk.
TALK1, where you receive good information for your mortgage needs, such as mortgage programs and foreclosure programs to help get you out of foreclosure. Stay tuned and hear what's coming your way.